I'm Jodie Fitzgerald. Welcome to the Platypus Reporting Season Wrap. I'm joined today by Don Williams, CIO of Platypus. Don, how would you describe the general feel of this reporting season?
I think the best way to describe it is a sense of relief. A lot of investors were worried that we'd roll into a new earnings downgrade cycle, based on the fact that there's still potholes in the domestic economy, and so there was a real fear that we'd see a lot of poor results, and that didn't happen. And what we have seen is companies producing pretty reasonable results, and share prices responding accordingly.
Have there been any notable surprises, either positive or negative?
Yeah, there's been a number on both sides. CBA was a positive surprise, and I think a very important one for the market given how widely held that particular stock is. We also saw good results from companies like Seek, Super Retail Group in the consumer discretionary space had a great set of numbers as well. So there were a number of positive surprises. On the negative side, there were quite a few former market darlings that had quite poor results, and the share prices got belted pretty hard. Good examples of that are SAI Global and What If had pretty poor numbers as well, and the share prices went down substantially.
Are there any common themes among those stocks?
The only theme with those names is they've been trading at a big premium to the market for some time, and investors have been very patient with those particular companies, we believe. We think that they haven't been producing results that justify the valuation, and we finally have seen that normalise during this season.
The retail sector's been struggling for some time. What's your take on the results of some of the companies like JB Hi-Fi and the market's take on those results?
We definitely saw stabilisation in the retail sector. Harvey Norman also produced better numbers this reporting season. So I think what we can take away from that is, at least in the retail sector, there has been stabilisation of earnings. JB Hi-Fi surprised the market by maintaining their margin, and that was a very positive outcome and led to quite significant earnings upgrades for that particular name.
Yield is a buzzword at the moment, and it really has meant that banks and REITs have been quite popular over the last couple of years. What's your view on the valuations of those sorts of companies?
They're starting to get stretched, there's no doubt about that. If I just take the banks, for example, they've had a tremendous return over the last 4 or 5 months. There is still the potential for valuation upside in the banks based on the historic valuation ranges. However, I think it's fair to say they're expensive now, and we're probably into the last part of that yield-based re-rating. Yield will remain a theme in the market though. I think what you're likely to see though is people rotating out of some of the traditional yield names into some industrial companies that have got some earnings growth where there's good yield as well.
We've finally seen the market break through the 5,000 barrier, which is the top end of the range it's been trading in for some time. We've also seen EPS starting to tick up. Do you think that this could be the start of the next bull market run? We
think that's more likely than not, actually. We have seen earnings tick up over the last 4 or 5 weeks, and it's way too early to say that that's a trend. But if that continues for the next 6 to 8 weeks, I think the market will continue to move higher. The market has traded a lot better over the last 9 months than it has in the 3 years prior. So that's another positive, and we're seeing genuine interest in the stock market. We think for the first time since 2009.
We haven't seen business confidence tick up yet. We also know that businesses really do need to increase their productivity, which might lead into further unemployment. Why do you believe that there's momentum behind these earnings?
Look, I think in the short term, what the consumer is doing is probably a little bit more important than what's happening in business, and we're definitely seeing an improvement in consumer sentiment. That was borne out through Christmas, where we actually had reasonable trading through Christmas, and from the results that we've seen, it's obvious that the heavy discounting that we saw 2 Christmases ago just didn't occur this year. So we think that's a positive sign that the consumer is feeling better about spending and potentially investing as well. We think it's just a matter of time before business starts investing more broadly, and I'm talking about outside of the oil and gas and mining space. So we are expecting some more M&A in the domestically exposed parts of the market this calendar year.
Given it's all about earnings, what's the risk that earnings will simply just roll over?
Yeah, unfortunately that's a possibility. The currency is still very high. It's uncomfortably high for a lot of domestically focused businesses, and there's still the possibility that we get a shock out of Europe and the most likely shock would be another credit problem with with a large European country that has too much debt. So you can't rule that out, and that would definitely cause some trouble for the market. But not without a shock, I think we'll continue to trade higher and head towards 6,000.
Where do you see the majority of opportunities in the market for the next 12 months?
Mainly in the domestically exposed companies, and there's two main reasons for that. The first is we think the economy is actually improving fundamentally, and if we do have some hiccup in the economy, the Reserve Bank will cut rates again, which will help support it. In addition, we think the currency has probably peaked and is likely to gradually drift down, and that will give a little bit more breathing space for these companies that have been suffering under the high Australian dollar. So that should give a boost to earnings for those names as well.
Thanks for your time today, Donald.
Thank you.